Hi everyone, and welcome to a new video that I made about stock investing, and this time I would like to talk about the power of long-term investing. And the reason I want to make this video is because I guess a lot of people are a little bit doubtful and lost a little bit of faith in the stock market recently, especially if you started to trade quite recently, let's say in 20 or 2021. For the first time, probably you really see your portfolio shrinking this year. And so what I would like to do here is to talk a little bit about the short-term effects, but also and more specifically about the long-term effects of the stock markets, and see if we can learn anything from what went on over the last couple of years. First of all, I would like to quickly look at the overall health of our companies. And what you see here, this is a list of the S&P 500 and the Euro Stoxx 600. What I did, I looked at the quarter 3 results of this year, and I compared the year-to-date quarter 3 results to the year-to-date quarter 3 results of last year, so 2022 versus 2021. And what you see is that for North America, 82% of the companies did better this year, have a higher revenue than last year. And in Europe, it's 84%. So overall, this is extremely good news. It means that we are very far from a recession. It means that our economy is still growing at a very strong pace. However, if you look at the net income of the companies, well, things are a little bit more challenging there. And you see that only 50% in North America and 54% in Europe of the companies are able to maintain or increase their net income. So in other words, the operational cost of the companies has increased quite tremendously. And we look at the free cash flow, it's even worse. There only 38% of the companies and 39% in Europe were able to maintain or increase their free cash flow. That of course has a lot of impact on the analyst ratings, because analysts will very often use the free cash flow estimates to calculate their intrinsic value or the fair value of a company or a stock. So if that goes down, then typically also the analyst ratings will also go down. And if you look at the share prices of the company, well, this is even worse. And you see that the stock market, well, only 25% of the stocks in the S&P 500 actually are higher this year than last year, quarter 3. And in Europe, it's even only 19%. So what you see here is that the stock market is reacting very, very pessimistically, very negatively on everything that's going on. So it has a very negative view on what's going on right now. So I would say this is the good news, so that the companies are still able to grow their business, but you also see that companies are struggling with some challenges, especially around free cash flow. And the stock market is extremely negative and extremely pessimistic about what's going on right now. So that brings us to the next question. Okay, this is this year compared to last year. So what does this mean on the long term? On the long term, you have to go back to the basic principles of stock investing. So what are the basic principles? Well, very simply, as a shareholder, you own a part of a business. And as a business owner, you are entitled, you will receive a portion of the future profit. And that's the basic principle. So either the profit will come to you in cash as dividends, either as capital appreciation, meaning that your company will reinvest the profit, will be able to grow. When it grows, will be worth more. And if the company is worth more, your shares also will be worth more. And the market will be inclined to give more money, to pay more money for your shares the day you want to sell them. That's the basic principle of long-term investing. In other words, if there's a profitability growth of a company, it will translate into a shareholder profit. So the company does well, so the shareholders will also do well. That's the basic principle of long-term stock investing. So the next question is, what should the correlation between shareholder profit and profitability of the company look like? And we could show that on a graph. So theoretically, So on the vertical axis here, you have the shareholder profit, which is a combination of the accumulated dividends over a long period of time and the share price increase. And on the horizontal axis here, you have the EPS growth, the profitability growth of year over year, and or the EPS decline, because EPS can also decline year over year. So what you would expect is that if the EPS or the profitability of the company increase, for instance, 25% every year, compounded annual growth, then you would also expect your share price, or at least the shareholder profit, so the dividend plus the share price increase, to be 25% as well. So you would expect that companies will all show here on this blue line here, so that their shareholder profit will be in line with their EPS growth. So I did the exercise for all the stocks in the S&P 500 and the Euro Stoxx 600, and these were the results after 3 years. After 3 years, every red dot that you see here is a correlation between the shareholder profit, so a combination of accumulated dividend over 3 years plus the share price increase, compared to the EPS growth or decline over those 3 years. So the first thing that you see, it's scattered all over the place. So there doesn't seem to be a very clear correlation. And actually the red line that you see here is the actual correlation between all these dots here. So there is a very slight, I would say, slope that's in line with the blue line here. But in general, I would say that there is almost no correlation whatsoever between these dots. So conclusion, most of the shares here, or the share prices, have increased over the last 3 years, so because they're above the horizontal axis, and they are quite randomly spread horizontally, meaning that as a shareholder you would make a return whatever the EPS did over the last 3 years. So 3 years, you don't really see a very clear correlation. If you would look at 5 years, things become a little bit more, I would say, correlated. You see here that the red line, the real correlation, starts to converge to the blue line. And if you would look at it over 10 years, then you really start to see the correlation take shape here. So 10 years, that's long-term investing. And so we talk about long-term investing. We're not talking about 6 months. We're not talking about 1 year. We're really talking about 5 to 10 years or even more. But then you see that all the red dots here, or almost all the red dots, are above the blue line. So it means that still the shareholder profit is higher than the EPS growth of the company. So which is extremely good news, and again showing that the stock market is quite optimistic. Now, the interesting thing to see also is that if you look at the S&P 500 or the Euro Stoxx 600, the pictures are pretty much the same. So you see the same pattern, so it really seems to be quite identical across the markets. So as a conclusion, the stock market is very optimistic. As I said, the shareholder return is typically higher than the EPS growth. Well, there is a clear correlation after 10 years. And when we talk about long-term investing, that's really what you have to talk about. It's 5 to 10 years. And it's quite consistent across the markets. So really demonstrating what we were trying to find here. So we really see that correlation. So let's try to find out if we can learn anything else out of this data here. And as I said, I analyzed 1,100 stocks here, S&P 500 and Euro Stoxx 600. First thing that you saw over 10 years is that 81% of the companies saw their share price increase. 89% saw the return on investment increase. So 80 companies were able to provide a shareholder return thanks to the fact that the company was paying dividend. So the dividend is really becoming a quite important differentiator over the long term. What you also see here is that the average return on investment over the market in general is 13.22% compounded annual growth. Only, and I was quite surprised when I saw these numbers, 75% of the companies have seen their EPS increase, so an increasing trend of their EPS over 10 years. I was quite surprised because S&P 500, Euro Stoxx 600 are the most successful companies in the world, so you would expect that their EPS would also go up. So only 75%. Now, 45% of the companies saw their EPS increase more than 5% every year, and 27% of the companies saw their EPS increase at a rate of an average rate of 10% every year, and 10% of the companies saw their EPS increase at an average rates of 20% or more every year. Now, to give you a little bit of an idea what 13.22% means, it means that if you had invested $100,000 in the stock market in January 2012, you would have had like $346,000 in average by December 2021. Now, little comment here, I'm looking at the December 2021 because I'm looking at the annual reports, and most of the annual reports are still dated from December last year. So of course we know December last year we were really at the peak of the stock exchange, so we were really at the top of a bull market. So things probably are a little bit different today. But all in all, I mean, if you would look at the overall growth that you would be able to make, or the profit you would be able to make on a portfolio simply by investing long term in the companies is quite significant. You would have been able to more than triple your initial investment over 10 years. Now, an interesting observation here is that if you would just have put your money into an ETF, a tracker of the S&P 500 10 years ago, you would even be able to make like a 15.3% annual return on your investment. So meaning that if instead of trying to beat the market and find all these companies that do well, you would just simply have put all of your money into a tracker of the S&P 500 10 years ago, you would have ended up with $415,000. And so you would have make almost, I would say $60,000 more than just trying to follow the market on average. So actually, I would say conclusion is that there's nothing wrong being a lazy investor. And that's also something I think that Warren Buffett said very often, is that for most investors, just simply investing in a tracker of the S&P 500 is the best option. Okay, so now let's see if there's any way we can even find more things that might influence the return on investment here. So what you have here is a graph, and so a correlation graph that you should now be familiar with. You see here the stock we analyzed as a table we saw previously, but now I also have some filtering capabilities here. And so there are probably some sectors in a stock market that did better than others. I think you all would expect that technology was a very successful sector to invest in 10 years ago. So let's see what the numbers are there. So if I filter the technology, you see we have 100 stocks here. And the first thing that you see here is that the average return on investment for technology was 18.5%. Already, I would say, outperforming the S&P 500. What you also notice that if the EPS increases, so if you would find companies in technology companies that would have an increasing EPS, you would have a 100% chance of being successful. And if you would find those companies that made up more than 20% compound annual growth every year, and 17 of these companies did this, you would have a 100% chance of being successful, and your average ROI would be 26.43%. So if you would have invested $100,000 10 years ago in the technology growing companies, you would now, on average, have $1 million in your portfolio. So the question is, of course, which are the companies, and I can show that. So let's go to the list here. Here's the list. So I would first we have to filter out the technology. Let's do that, technology. And then we look for the ones that have an EPS growth of 20%, so greater than 0.2, voila. And here is a list of the 17 companies that really made a very, very big ROI. And you see the usual suspects here. I guess Apple is here, Google is here, Microsoft is in here, but you also here is ASML, so which is, in my opinion, the most growing European company, and yeah, some others, and some that you might even not be too familiar with. But those companies really had a very successful run over the last 10 years and made an absolute fantastic return for the shareholders. You see here the growth period, that's the dividend growth period. You see that those companies, lots of them also were able to grow their dividend for 10 years in a row. So let's go back to our table here. And another quite familiar, I would say, a popular sector is the healthcare. Let's go to the healthcare. In healthcare, you also have, well, 101, almost 100 companies here. You see that the average return ROI is 17.97%. And if you would find again the companies with increasing EPS, 100% chance to be successful. And look at this, if you would have a compound annual growth of more than 20%, you would even make an average ROI of 31%, meaning that if you would have invested $100,000 in the rapidly growing healthcare companies, you would now have $1.5 million here. And those are 14 companies. Okay, let's also look at those 14 companies. If I would do the same filtering for healthcare, let's look healthcare here. Here are the companies that you have here. So you see the returns are quite staggering here. Yeah, so 57% here, 52% for Sartorius. That's a 52% yearly return. It's quite amazing. Some others, but so really, really rapidly growing companies. Now there are other sectors that are probably less successful. Let's take energy, for instance. Yeah, slightly less stocks, but you see that the average ROI for energy is 1.28%, again, including dividend. Now, you know, energy are quite hot stocks this year because of the evolution of the energy prices. But you see, over a long period of time, the last 10 years, that's probably was not the best place to put your money in. Now, if you would find the most successful ones again, then you would still make a pretty decent return as well. Yet, and another interesting group of companies to take a look at is the dividend aristocrats. So dividend aristocrats are companies that were able to increase their dividend for more than 25 years in a row. And we have 62 companies, so this is the, let's say, official list. And as you can see, the average return on investment yearly is 13.29, which is lower than the S&P 500. However, if you were able to pick a dividend aristocrats with an increasing EPS, you would have a 100% chance to make a profit, and you would still make a pretty decent profit. And one thing, and yeah, maybe you noticed this before, but one thing that is also important to notice here is that even if your EPS declines, and so out of those 62 dividend aristocrats, 14 saw their EPS decline over the last 10 years, well, 11 of those still saw their return on investment increase. And so although the EPS went down, yeah, for 11 companies, they still were able to make a return on investment. And the average return on investment was 11.7% on a yearly basis. And I think that's the nice thing about these kind of stocks, is that they're so robust and so trusted by the market that even if the EPS is declining, you still are able to make a profit. Not that I recommend you doing that, but it gives you a sense of safety, a sense of, I would say, trust in the stock market. This brings me to the conclusion of this video today. So I hope that you learned a few things here. And so first of all, when we talk about long term, you see, we're not talking about 6 months here, we're not talking about 1 year, we're talking about 5 to 10 years. So patience is going to be really your best ally. A more pleasant thing that you learned is that there's nothing wrong being a lazy investor. Put your money into a tracker of the S&P 500 or put it in a very solid holding company. A holding company is also a very good place to put your money, because the leaders of the company, of the holding company, have a lot of skin in the game. So they are shareholders themselves, so they will also do whatever they can to make this company a success. Try to find companies that will substantially grow in the next years. So try to find those big growth, those opportunities, but be careful, not taking too many risks here, but try to find yourself and try to take those solid companies that have a lot of potential to grow. You saw in the list the big growers: Microsoft, Apple, Google. Those are not small companies, they are extremely big companies, and they still were able to grow quite substantially over the last 10 years. So there's nothing wrong in picking large companies, but make sure that you pick those companies where you see a bright future. And finally, take advantage of the market dips. As you saw in the very beginning, the market is overreacting now to the bad news in the world. And I would say that this creates opportunities. You probably can find now companies that are much cheaper on the market than their value. So you will probably be able now to start picking some very cheap stocks that will go up quite rapidly in the future. So I hope this was useful, and that you learned something here. At least I did a lot by doing all this research and going through the numbers here. So feel free to give me a thumbs up and to leave a comment. I will be more than happy to react on them. And I hope to see you very soon in a new video. Bye.